the way I look at, what I've done with my residential real estate career and this career is just a way for freedom. So I feel as if this is a path to freedom. Ultimately money is a tool to buy you more freedom, not to buy more possessions.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hennche. Welcome back to The Path to Wealth. I'm your host, Hennche. Today we have the pleasure of speaking with Craig McGrouther, the Director of Business Development at Lone Star Capital. Craig has an impressive 7-year career in real estate sales, having successfully sold over 100 homes before making the successful transition to Lone Star Capital. Now, as part of the team that oversees the growth and management of over 2,500 apartment units, Craig also dedicates his time to volunteering for Habitat for Humanity. Join us as we delve into Craig's journey from his days as a real estate agent to his current role as a key decision maker in a thriving multifamily investment firm based in Manhattan. Thank you for joining us today, Greg.
Thank you so much for having me.
So, maybe one of the first questions: what is your role at Lone Star Capital encompass? Like, what do you do on a day to day there?
Yeah, absolutely. So every day is a little bit different, which is something that I like, and that's kind of the world in real estate. Things are fluid, and sometimes you get called into something that you didn't think you were going to do that day. Sometimes you're doing podcasts like this, so it really just depends. But generally speaking, my role is a lot of the outreach. My technical title is Director of Business Development, but ultimately I make sure that the capital stack is filled. We have the proper amount of equity going into our deals. I'm pitching opportunities, growing new relationship or creating new relationships, growing existing ones, and kind of continuing and doing a lot of the outreach and communication and calling for deals. And then a lot of podcasts and content creation as well. I host 2 shows with Rob is on it, and then other fan managers in the industry in it too. So a little bit of everything, I would say. So it keeps it fun.
Mm-hmm. That's nice. No, so you don't get like a bunch of day to day where it's just all the same, and it actually becomes an interesting overall experience throughout the year. You get to go through different conferences, you get to host your own shows, you get to make connections, which keeps it all very vibrant.
Most definitely, yeah. No, my head's not buried in the spreadsheets, if you will. And frankly, in the finance world or multifamily world, it is all spreadsheets. And yes, I have an understanding of it. I get debriefed when we have a new deal to go through with it. Brad Oliver, who's our director of acquisitions, will give me an afternoon where we'll go through and deep dive, and I'll ask him a bunch of questions. I'll poke holes in our deals. I'll figure out kind of ways, as other investors and capital raising partners work with us. Some of the questions that I typically get, I make sure to ask him to kind of cross reference and to see if there's, good answers that we'll get typically asked, because I'm, usually in the forefront of what that looks like. But, I fortunately don't have to always be in the spreadsheets, although I need to understand them, via Excel. But to your point, always going to conferences, kind of whining and dining a lot of our investors and capital partners, and new relationships we're looking to cultivate. So it's a really fun role and position I get to be in. And typically speaking, no 2 day really looks the same, which is nice. And I can kind of get the autonomy to kind of control my schedule. And if I know if I'm really busy, to block out days to some catch up. And if I know we're going to do and release a new deal, I will block out my schedule to make sure that everyone's getting the proper call and attention, to make sure they can understand the opportunity that they may or may not be investing in, and to show people why we love the opportunity.
So your investor spread, from what I understand, it's 75% individual syndication investors and maybe 25% JVs with family offices. Is that's where you're spending your time, kind of communicating with both of them, navigating them through new upcoming deals and seeing where there's potential to raise more capital for those individual deals?
Yeah, that's a interesting way to kind of think about the phrasing and posturing of who we speak with and whatnot. I would say, typically speaking, it just depends, in the sense that There's some deals that are too small for, family offices, for JV equity partners, institutional money. If a deal is less than kind of an $8 million raise, it's typically too small for them. So we did a deal earlier this year that we wouldn't normally do, but it was right next door to one of our properties that's a 300 plus unit property. So we figured that it made sense from an economies of scale perspective to add a 90 unit deal. That was only a $5.5 million raise. We got it filled up from an equity perspective all through 1031 exchanges, which were just more mom and pop owners, not big real estate
Yeah.
funds or anything like that. So that was a situation where there was no JV equity or institutional equity family offices. There was more just retail in-house relationships that we had there. And then there's opportunities that we're shopping out right now that were just put up into contract that are geared more towards the institutional equity. And kind of when we look at it is, if you think of a glass, right? A deal is an empty jar. The big players like that are the big stones that would come in, and then you have fund managers and other maybe co-GPs that will come into the smaller, more medium-sized stones, and then the retail investors, our friends and family, can kind of be smaller pebbles to sand that are that 50K to a $500,000 checks that will come in there, in no particular size or order, that will kind of fill it out. But it's usually take the big stone in there, then the medium stones and the smaller stones, and it usually kind of flows there. So once we get a direction as to equity in which we want to go, and we get some good understanding of who may or may not be interested in the deal, then we kind of figure out best case and strategy to kind of fill up the gaps and to make sure the tranche is full.
So, how do you deal with the current sentiment of investors, whether they are larger or smaller? I think everybody is a bit more hesitant than not too long ago. And yeah, how do you, as somebody who's communicating on a daily basis and also positioning new deals, deal with maybe that setback in fund inflow or, you know?
Yeah, it's interesting because, to your point, leverage before, and it's getting better now because cap rates have finally widened and rates are kind of stabilizing and or are going to be trending down moving forward. How much they're going to get cut, we don't know, but cap rates have certainly expanded, which means leverage is getting a bit better. But before, in 2023, it is almost the end of the year, of course, from time's sake perspective. But there was a point where leverage was really, really tough and equity is really tough. So, raising $1 in this year was like raising $3 before with the challenge.
Yeah.
Plus, we had to raise about double the money before. So that was really the hardest part. But now it's getting a little bit easier to, I'm not going to say easier, but the leverage is getting better. So raising is a little bit more easy. But one thing I will say is this, is that if you were willing to invest when the market was really hot, you should be more than happy to invest right now, because right now is the times where real gains are going to be made, not kind of closer to the end of the cycle. That was riskier than it is investing right now. From a fundamentals perspective, when people are really scared, when, sentiment is what it is right now, and there's distress in the market, is when people should be getting greedy. So the kind of the narrative and the thought process I'm having right now is, hey, if you're willing to, invest in a deal with a sub 4 or 5% cap rate, then if you look at a 6% cap rate right now or 7% cap rate, you should be double the excitement to put your money into these deals currently. And the way we also look at it is, if a deal pencils out right now with interest rates being this high, then it's really going to make sense when rates get cut, a whole 50 bips to 100 basis points, in the next, year, hopefully to 18 months, or 2 to 3 years, depending upon how you kind of forecast that. The way we kind of mitigate that is we look for fixed rate debt deals where we know that over the course of the hold period, we're going to have a 5-year fixed rate debt to 7-year debt note, where we know at some point in that 5 to 7 year tarmac and window, we'll be able to exit the deal in greener pastures than where it is right now. And if we buy with good basis, with good leverage, with quality reserves, regardless of what happens in the market, we should be able to kind of stand weather the storm, and also find a good departure from the property over that window.
Hmm. Where would you say is the key difference in communication between the larger check writers and the smaller ones, as to the understanding of the overall cycle and as well as maybe the risk appetite that you're seeing?
I would definitely say that those who are in the institutional space have a lot more rigid fundamentals and philosophies, and need to see certain numbers before, and there's not as much window dressing and salesmanship with regards to the deal. It's more of, hey, give me the cold hard facts. What's the going in cap? What's your projected exit cap? What's your stabilized yield on cost? What's your equity multiple? What's the cash and cash? What are the terms? Give me the quick facts versus more of the friends and family, the retail people. They kind of want to get sold as to the why. What's the deal? What's the story on this one? Who's the owner? Why is this a good opportunity? Kind of explain that side of the business to me. A little bit more emotional as opposed to factual. So I would say, typically speaking, that's what you work against and sell against. And sometimes that thought process is really solid. And sometimes we find institutional people being a little bit too rigid, but they're ultimately at mercy of their IC, which is their investor committee, which is
Yeah.
basically geared to say no to everything and be super, super skeptical because they're managing millions upon millions of dollars of their investors' capital that they have to be very protective of. And ultimately, right now, there's not a lot of upside in saying yes to something and being, early, but there's a lot of groupthink in that regard, but it makes sense. They'd rather just wait to see what's going on. And, frankly, some of these groups smartly are also seeing maybe what's going on in their portfolio. And if there's someone who's got distress there, they know that, hey, right now is not a good time because the distress hasn't come, but it's going to come and call it 6 months, 12 months. So that's the time we're going to redeploy as opposed to right now. So everyone's got a different philosophy, and a lot of people are saying they're not, as they say in the industry, pencils down, but they're basically pencils down unless a group like us can find a true unicorn in which every other group would want to do. But if that's the case, then maybe they'd go through the deal. But a lot of groups are really, really particular with what they want right now, as opposed to, retail money. Someone may have sold a company and have a couple, $1 million to deploy, and they've got some tax issues to offset, or there's a life event going on, or they just have money burning a hole in their wallet and they have to make their yearly allocation to, real estate investment, and they find their way into our deal. So there's a lot more motivation and reasons for them to invest there as opposed to institutional people that could probably not do a deal for a year or two and be perfectly fine because, they're, you know, I guess their world doesn't change if they do a deal or don't do a deal right now, at least, considering we're kind of in that in between period in time.
Yeah. You've already touched up on it, but where do you see us being in that distress curve? We've seen some deals collapse in 2020. We've seen more so in 23. But where do you think over the arc of the next couple of years, where are we in that distress curve where debt is becoming an issue for the deals?
Right. Well, from a debt perspective, 2024 and 2025 is when we'll start seeing some items coming up. So if you did a bridge rate, bridge or floating rate debt deal in kind of the end of 2020 and you didn't exit it, or 2021, and typically they're 2 to 3 year deals. So there could be an extension period right now, or it could be a situation where, people are prepared to walk away from the property or just sell it right now. So I would say that 2024 and 2025 will yield a lot of that, and a lot of it will be ironed out. Those who will, make it will try to make it. But, unfortunately, you can extend for a year, but the math still doesn't work if you only are extending it for a year. You really need to be extending it, getting, cash and refinance if you need to do that into a agency, long-term debt note. And if you can't do that, then you kind of just got to exit from the property because the math is just not in your favor with where cap rates were and the yields were on purchase to where they are, in the exiting market here coming up in the next couple of years. So I definitely think there's going to be a lot of distressed opportunities here coming up, not due to, terrible performance, although as the recession starts to hit, we'll see that likely in some markets more than others. But without a doubt, we're going to see, debt distress here coming up pretty heavily. I would imagine in second half of the year, some dominoes will fall. And then in 2025, we'll see more of that as well. There could be some workouts if you're a bigger group. But what I think we're going to see is a lot of smaller groups that are kind of sub $100 million of assets under management, and kind of sponsors like that who are maybe a little bit earlier or just bought at the wrong time, which a lot of people have with the bad with not the proper structuring of debt and equity, are going to have to turn back properties or, kind of distribute, deals, and, sell for a loss. So I think that's all coming in the next, 18 months. I'm not, going out on a limb by saying that, but it is just ultimately a mathematical equation that people can't outrun, frankly.
Yeah. You did touch up on recession a bit. How do you think that applies to the Texas market where Lone Star is so heavily focused on?
Yeah, so we're only and exclusively in Texas, and to that point, we're only in Dallas, Houston, and San Antonio. We're making our first acquisition in San Antonio. We have our second acquisition that we are working on getting under PSA and under control as we speak right now, which is exciting as well. Texas, we do like it because it's very pro-business, and we do feel as if there's a bit more of a moat around Texas due to the growth trends and population and people going there, but no one can outrun bad market fundamentals, unemployment, creeping up, and wages not growing. So we do think we're going to see a bit of slowdown in the market there. But I think Texas and the markets that we're in, specifically with Houston growing so much, Dallas obviously being as robust as Dallas is, in San Antonio, having really solid jobs and demographics there, we do feel as if those markets are very well equipped to handle a recession and will do better than a lot of other markets. And that's kind of why we're in those primary markets and not in the tertiary or secondary markets, if you will. We want to be in the prime areas that will be a little bit more robust and sturdy through an economic slide. So, there will be some impact. To the extent, I'm not sure, but I do feel confident that, we chose those markets for a reason to handle the storm and weather everything that's going to come, should the market not be as good. And, ultimately, Texas has really great tailwinds that some states aren't having right now, due to, wage growth happening and population growth currently going on and people moving there more than leaving. We do feel good about it. But, ultimately, we try to mitigate any issues with not having and acquiring many deals with a bunch of supply coming up, which a lot of markets are going to experience. Like, for instance, Austin has a bunch of supply coming up. They say Texas, you can always build, but we like to make sure that there's not too much construction or new inventory coming up within a couple mile radius to kind of mitigate some of those issues.
Yeah, that's actually something we've seen close to one of our properties in Nashville, Tennessee, where I felt like when we first started looking at the market and then when we returned to buy that one particular property, felt like half of the city was newly built. Like especially the periphery around the city is the amount of new supply there was insane.
Absolutely. And Austin, Texas, everyone says Austin, 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 but we kind of want to run away from it for many reasons. First off, it kind of functions as a coastal market with regards to cap rates and whatnot. So it's very challenging. It's very tech reliant. And tech right now, ultimately, as we all know, is kind of getting hit a bit due to, jobs and whatnot, kind of getting laid off. Although I do think Austin will be fine long term. It's definitely kind of experiencing some issues there, but it's also dealing with 50,000 new units coming to market, in Texas, which will have absorption issues. So kind of the way I look at it is like, well, maybe in 2 years, when cap rates have widened naturally, not due to bad fundamentals there, but just due to new supply, maybe it's time for us in a group to come in and maybe come in and, kind of put our stake in the ground and kind of buy some of these distressed properties due to absorption coming in. But, it's a challenge for sure to look at. And, one thing we like to do is, as I said, is really look at Yardi and the CoStar reports to see, okay, is there supply coming in this area? Okay, is there supply? What's, what's under construction? What's being planned? And the great thing is the newest acquisition we have in San Antonio right now will have zero, new inventory coming up in a 2 mile radius, which makes us feel great. The deal in Dallas that we have doesn't have much, and then the other two acquisitions we had coming up, or the other several acquisitions we did this year, essentially have very, very little new inventory coming near. Most deals have less than 1%, if not none, coming up, which is really exciting for us because to that point, that's your competition. So that's why we like the workforce space, not the the a asset type. So we like to make sure that we're in kind of that more suburban area where it's harder to replicate the units and whatnot and supply in that area.
What kind of vintage overall do you focus on?
We like to go for 80s and newer. That's not to say we wouldn't, buy the right opportunity for, late 70s and stuff. What I do find interesting though is that institutional groups more and more are kind of seeking, later 80s products or 90s even. Some groups won't even touch 80s or 70s anymore. And it's kind of funny when the market got really hot like it was before, there wasn't as much of a handicap or price gap between 70s, 80s, and 90s assets, which I'm sure you've seen, or even newer product, right? The cap was so tight. But now what we're finally seeing is an opportunity to get paid for your risk and paid for buying, 70s and 80s vintage and assets as opposed to, the tightness before. So you think about, if you were to buy, a bridge deal or floating rate debt deal on, 70s or early 80s product, well, the caps are really starting to widen there as opposed to now 90s and thousands and teens assets. We try to typically focus on the 80s or newer. Sometimes we get into Texas and it's, 70s and whatnot, boilers, chillers, lower ceilings, which is just less desirable. So ideally, we're getting 80s and 90s, product at the moment. The most recent deal that we just closed, which is a 3 property portfolio in Houston. One deal is a 2008 building, which is a mid-rise property. That was a really beautiful property. That's the nicest we have in our portfolio. And then the other two, the second and third nicest properties are also in the acquisition as well, which was a 1999 and 1994 properties which border each other. Those are garden style assets, which were pretty great. So that's kind of ideally what we would like to acquire is, 85 or newer, but we're not going to discriminate if the deal makes sense in, kind of that the 80s to, late 70s. But, now more than ever, we have to ask ourselves a couple of questions. What's worth us doing? Because opportunities are a lot more abundant and plentiful right now. So there's less buyers in the market right now than was before. It only takes two to make a market, but with cap rates expanding and whatnot, and sellers having to get out from the properties, buyers kind of have more leverage. So we have to ask ourselves a question: it doesn't make sense to buy the 70s or earlier 80s product, or does it make sense for us to buy the 90s and 00 stuff? Because if we have our choice and our pick of the litter, what makes more sense for us to do? What's easier to raise for? What would we rather own if we have to own it for 7 to 10 years? And the answer is likely going to be the newer and better, asset type, which is going to naturally be the, thousands and 90s product.
Yeah, I think especially if it's all things being equal, it's always better to have the newer inventory. Where do you currently see the biggest potential to improve assets that you're purchasing? Like what's the game plan for the new San Antonio property?
Yeah, so that one's utilizing a very interesting tax abatement play. But frankly, this opportunity is really great. Where we're getting, we're working to get some sort of partial or full tax abatement on the opportunity. Naturally, in Texas, if you can eliminate your property taxes, your NOI is going to boost up immensely. So, for instance, the 3 properties we just closed, we utilized a very unique Texas state program that gave us 100% tax abatement in return that effectively gave us a 50% NOI bump basically by doing nothing day one, which, as you can imagine, is some
Yeah,
pretty sweet investment alpha for our investors, which is great. A lot of complexity there, but with complexity comes upside. But this deal, interestingly enough, is just going in with great fundamentals and awesome going in cap rate, which is, I think it's about 7, it's in the sevens, but then our debt is about mid sixes. So there's about 120 points, basis points of positive leverage. So that coupled with just getting occupancy up, and then we're going to do partial renovations on about every unit, about a budget of $5,000 a unit, roughly, give or take. And then, some very, very small other income added there. But that's not really a big lift. That's just buying on good fundamentals and selling in a better market. So buying in a distressed time and selling in a more stabilized time is kind of ultimately a play there. And those are deals that we actually do want to do right now. Yeah, we would like to add some yield to the property, add extra income, and tighten that up. But if we can get deals that are just distressed from bad debt and equity set up on it, not necessarily the property not performing
yeah.
well, that gets us excited.
Yeah, I mean that makes perfect sense as a business case. If you can pick up a property that's financially distressed, you don't have to deal with the stress of lifting up the property out of a physical distress that it might be in, or
And,
having a
and, and
bunch
that's
of bad tenants.
Yeah, exactly. And that's the thing right now we're not really trying to do is dealing with a huge lift. First off, we know occupancy is not bad yet, but it will get bad. Secondly, we want to do agency debt. And for those who don't know what agency debt means, that's, Freddie and Fannie Mae's debt profile, which is, government backed, it's agency lending, but they have occupancy restrictions and requirements. So we're not really looking to take, massive lifts and putting bridge debt on deals. If we have to do it for the right opportunity, we might, but exiting in 2 years almost feels a little bit more like gambling than putting together a 5 to 7 year business plan with fixed rate debt, where we know that, hey, in 5 years, call it in 2020, like if call it 2024 and 2029, or 2030, there's a very higher likelihood that it'll be a better and cleaner market to exit in right now. And if we don't have to take on headaches, then why would we do that? We'd rather have a smoother business and you generate a nice mid-teen IRR with really good cash flow, with a better tenant profile. That's going to be, not as of a headache for us to maintain, where we're focusing overly on one property in our portfolio while we've got, 17 other deals we're managing. That's beneficial for us. So we have to start asking ourselves the questions: what makes sense for us? What risk is the risk we want to take on? And coming up, or there's going to be a bunch of options. Well, what options do we actually want to go with? Like, what's our philosophy as we change in this market right now? And I think the answer is, a mix of just better properties that are newer with good profiles and ultimately good incomes.
Yeah. And I think especially if we're looking at a potential recession that might have a negative impact on employment, we do want to have properties that are already full of good people in the sense that they have job stability. You don't want to pick up the challenged properties that already have challenged tenants.
You're absolutely right. And that's kind of goes back to the, again, the asset grades that we're looking at. And we rather go B plus right now, maybe even light A minus due to what you just mentioned. Because, if we can get incomes that are north of 60K a year, for a tenant, that's really attractive to us. So you get, lower quality tenants, with, less job stability coming up here, that's gonna be very problematic.
What are some of the questions from potential investors that you don't like to hear?
Hmm. What are some questions that I don't like to hear? That's actually never been asked that question before. I like that one. Um, if they don't understand, the business plan, that makes it challenging, or, if they don't necessarily agree with how we're getting our other income there, that's always a challenging thing because that's kind of more of a, an opinion thing as opposed to factually speaking. So that can be a question or a challenge. Or also if they're not fully comprehending our, affordable plan, or they don't necessarily believe in what that looks like, or, if they're just struggling to understand, where we're coming in with our exit cap, that can be a challenge because that's more of a, philosophy and opinion more than, that's speculative to a certain extent. And we have sensitivities to break that out. So that can be a little bit more of a challenging and lesser fun conversation, if you will.
Yeah. So one of the things that I like to do, I think in general in life, is seeing who is most aligned with what we or I are planning to do. Is that something that Lone Star is kind of doing too? I think Tim Ferriss calls it fire your bad customers. Like the customers that take away most of your time eventually. Is that something where you're trying to find natural alignment first before you even get them on board?
So naturally, we would like to, in a perfect world, have a situation in which there's no one we don't want to work with. But unfortunately, until you start and get into a deal, you don't know what the other person's going to provide on the other end. So we have experienced recently some people that we never want to work with again, that we're kind of married to, and unfortunately probably be married to a little bit longer due to the market
Yeah.
conditions, which is okay. That happens. But to your point, we definitely have a, an in-house conversation anytime we launch a deal with who we actually want to work with and who's a pleasure to work with. So fortunately, we have ironed out who are our players, and naturally, if we get a referral from said person, typically speaking, that person will be more agreeable or be easier to work with as opposed to what other people can be like, right? So it definitely is a balancing act, and we do try to set very proper expectations about what they're going to get from us and what we expect from them. And we want to make sure there's a situation in which we have full aligned interest in that regard. But ultimately as well, one thing that I always say to our in-house investors, our friends and families and stuff, and people that get referred to is, I need you to love the deal as much as we like the deal, because if you're iffy on the deal and then you invest in it and it doesn't go right, you're going to be asking me a lot of questions and I'm going to have to answer a lot of things. And if you didn't feel good about going in and the deal doesn't work
Mm.
out, you're really going to not like me and not like the deal. So if I ever feel as if someone's kind of wavering, I usually give them an out saying, hey, if you don't fully love this deal, we're going to do about 5 more coming up in the next 12 months, or whatever it may be. Let's just get you on the next one if you like it more. But life's too short to deal with people that, don't fully love your opportunity and that are kind of iffy on the opportunity. Or, some people are a little more strapped for cash. There's some people that, make millions of dollars a year that want to invest with you and they want to try you out, and they may not love the deal, but, them throwing 50 grand to 100 grand into a deal is nothing for them. That's just, a sample. That's a little appetizer so they can get a feel for us. Then I'm going to, not kind of give them that option as much. I mean, naturally, I'll do whatever I think is best for them, or kind of steer them the right way. But they're ultimately savvy and they can make a big decision. But someone who maybe has never made a real estate investment is kind of on the fence. that's gonna be a time in which I'm not gonna, fully press them, or that's definitely a time I'll give them an out, and I'll look for other places for the equity before I kind of press on them, or follow up them any extra.
Yeah, that makes sense. Especially, I mean, if somebody throws in 50 and could throw in a million, that's truly just a test and to see how's Lone Star working, how are they communicating, how reliable are they, and what would you say is kind of best in class conduct, whether somebody is a co-GP to Lone Star or an LP? Like, who do you really want to work with and why?
We want to work with everyone because we do think that a robust capital stack is important, and not every deal is a fit for every single person. There might be someone who is really, really loving risk and loves deals where the LTV is maxed out, and you're doing 20% or 80% LTV, and then you're throwing pref in there, and you're really potentially going to have a very high upside if the deal is north of a 15 IRR, because all the extra that will come from loading up pref. So there's situations in which we'll have fund managers or co-GPs or retail investors that like that risk, and there's some people that want to have very, very conservative LTV, and want to have way less leverage, that has and that's totally a different investor too. So there's different strokes for different folks. I think the biggest thing is just having people and having partners that have aligned interest, and that's due to just on a project level, and having people having an understanding, and people getting comfortable. So everyone wants kind of different things. Ultimately, having a bit of everyone in the mix of fund managers, co-GPs, and institutional equity and family offices makes for the best possible outcome for us, and keeps us sharp as to what people are looking for too. Because we get feedback all the time for yeses and nos, why people like the deal, why people didn't like the deal, and that's always been interesting and helpful on our end as to what certain groups are doing.
Yeah. Where do you think the feedback currently lies when people don't like deals where you have to maybe sharpen the pencil or find a different inventory? What is kind of the common denominator there where people don't
That's
like
a
it?
great question. Yeah, so the most recent deal that we've done was just a little too much leverage, but we've had so many points of positive leverage, meaning cap rate here and debt here. So that delta is positive leverage. So due to positive leverage, we can get basically maximum leverage that will be allowed from agencies, and max proceeds from lenders. So some institutional players don't like that. So that's been some feedback recently, is that too much leverage there. And then the other kind of play is cap rate exit, and where they feel good about that. They want to see cap rates, really high, and we do think that the deals from a sensitivity level do project well, but they're just trying to be cautious. And as I said earlier, a lot of these groups are, saying they're not pencils down, but they really are pencils down, because they're looking for a unicorn in which everyone else would say yes to the deal if they said yes to it too. So
Yeah. Kind of shifting gears. Where would you say your appetite for real estate came from when you initially became an agent?
I always wanted to sell real estate. So I always wanted to be in the business. For whatever reason, when I grew up, I always knew I wanted to sell homes or just be there. And then I kind of figured out the evolution of that world was, not as scalable as what this could be. And the opportunity in the private equity space, and to work with a firm and be, partnered here, makes a lot of sense. But, I always had an appetite for it. I always loved design, architecture, living, and kind of the different nuances that, you could do with homes. So I always loved that, and it always made sense to me. So that's kind of what my appetite came in when I was a kid. I was watching sports or home shows for whatever reason. I don't know why, but I always just had the desire and appetite for it.
Mhm. So your strength as a communicator, is that something that you honed in those 7 years selling real estate, or is it something that was natural to you that you build on?
I would say that it's a little bit more natural for me. However, I would say that my communications and interpersonal skills are some things that are my stronger suits. But doing a lot of sales, and selling a lot of homes, and negotiating a lot, writing a lot of contracts, and handling people has been an invaluable experience, where you get a lot of repetitions at it, and you can't substitute for that from a professional perspective. So no matter how talented you may or may not be with people, the business side of things, and the sales side of any business will really train you to get sharp and handle people very well. and teach you patience. And there's just negotiations that will happen with negotiations and escrows, and with this process with raising money that you can't learn unless you're doing it yourself. So it always has to be coupled with natural ability paired with on the job learning.
Yeah. Where would you say people allow themselves to lose patience most often and maybe blow up a deal? And that could even be in maybe just buying a house or selling a house. Where do you think that most people lose their temper or they cool in the process?
They get hung up on small things that like a couple $100 fees here and there just because maybe they get overwhelmed. But in all reality, I'm pretty loose with this. I'm never going to get caught up in anything that's going to cost me less than $1,000 just because, if I want something, I'll believe in the long term vision of it. I'm not going to get caught up in the nuance of, $100 here, $100 there, small little petty things that are, really not actually big issues. It's things like that. I understand if, there's a big roof or an air conditioning unit that's, not working correctly, especially where I've sold houses, which was in Arizona. Those are really important things, right? But it's the small little petty things, the death by a thousand paper cuts that, always was a little silly to me. But it happens and people do get emotional because this is a big investment, and, it's an opportunity cost play as well. What if you're saying yes to something, you're saying no to every other option, right? So people really do get, worked up there. And, the market was so hot recently, people had a lot less time to think about it. But I do think when the market was hot like that, it was a unique situation because people realized if their contract did get accepted, that they kind of had to go through with it because it wasn't easy to navigate the process, right? Now, with the market changing, people are really particular and are getting very sensitive to not getting everything catered to. So it's kind of the whipsaw effect on that. So now people, and before, as the market shifted back to being more normal now, people are, getting worked up about the smaller things, which is before they knew that wasn't really a possibility to get corrected in their escrow process.
Yeah, if they would get hung up on anything, they just wouldn't get it.
Exactly. They go, okay, fine. Well, another buyer here is going to pay a higher price, and I got a contract here, so let me know. It's kind of a take or leave it. Now, that's not really the case.
Yeah. And then one of my favorite questions, or maybe altogether, what do you consider a life well lived?
That's a really good question. A life well lived is probably a life with family and work purpose. So, I think having a family is really crucial. I would like to start mine at some point. I'm not married, don't have any kids yet, but that will definitely be the highlight of my life. So, life well lived would be consisting of great family, traveling, seeing the world and experiencing, and then a life filled with purpose and enjoyment via work. Because if you don't like your day today, you're spending a third of your life sleeping, a third of your life working, and then a third of your life enjoying everything else that there is to offer. But if you're miserable and not fulfilled or pleased during your work day, that sounds like a terrible way to live and spend your existence here. So I think solving for your work situation and your family matters, everything else will take care of itself from there.
Yeah, where do you currently see the purpose in the day to day what you're doing? How do you apply that sense of purpose to the world right now?
So the way I look at, what I've done with my residential real estate career and this career is just a way for freedom. So I feel as if this is a path to freedom. Ultimately money is a tool to buy you more freedom, not to buy more possessions. I'm not the most materialistic person. I ultimately like to travel. I want to hang out with friends. I want to eat good food. I don't need a million things. I don't need the biggest house in the world. That's silly to me. I don't need to be driving the nicest and the latest, greatest car. That's not really important to me. But what would be important to me is have a couple $1 million working for me, passively generating me revenue where I have the option to work as much or as little as I want to work, especially as I start to age. I'm only 29, but my goal is by the time I'm 50 and 60 that I have so much, equity in all these deals that I'm having, money coming into me automatically without having to think about it. Similarly, I feel as if what I'm doing right now is helping people get to those goals with passive income and, helping them get into real estate opportunities that they wouldn't be able to before. So that's kind of the purpose I see, that I get to help people do what ultimately I want to do and that what I'm drawn to. And I get to kind of walk them through it, hold their hands, and kind of be their shepherd in that regard to kind of helping them create maybe opportunities that they didn't think was possible or that they haven't had before.
Yeah, I can relate to that. I usually tend to say that every check we return to our investors is like a dream enabled. There's somebody has a dream, whether they want to put their kids to college or they want to buy their next home or something, and every dollar on top of what they originally gave us is enabling that.
Absolutely. And that's the thing is that, ultimately it's one deal at a time, one check at a time, but putting that motion together is important. And I think people my age, specifically because I'm 29, homeownership is kind of becoming something that's going to change, and it's becoming something that will not be as much of available. It may be an option for a lot of people because of the expense associated with it. But investing in deals like multifamily deals that we have, or other past investments, will be more of a mainstream thought, and that will be the way they can do it. So, helping people find these options, helping people understand, the deals, and the shortcomings that other groups may have, or learning how to underwrite and dissect a deal, and being able to actually transcribe a very robust and detailed Excel spreadsheet gives me joy, because I was someone that had no knowledge of that, wasn't really experienced in that side, and had to learn it. But if I can learn it, really anyone can. So.
So where and when did your money mindset come to life? Like, is that something that was passed on to you by somebody in the family, or is it somebody that you kind of maybe came around through real estate?
I would say that my dad always was harping on this stuff. My dad's a financial advisor and has been for over 30 years at Morgan Stanley. So he's been very successful there. So those principles were instilled into me, and were kind of very much so were top of mind, to say the least. So he certainly helped shape that thought, and put those thoughts in my head to be thinking about retirement, to be thinking about investing, and to be making sound decisions.
Nice. I like that. That's there's something to that when it's running in the family, and where the true legacy is actually the mindset and how to think about money, not to maybe also what to do with the money, but it's not just passing on the money.
Exactly. And passing on is one thing, right? You could pass on money, but okay, with bad knowledge, with lack of information, you could spend that and blow through right away. But if you can teach someone how to fish and instill good principles into them, that can sustain, generations, right? So that's ultimately the goal is, and the best thing is be coupled with both, to get the money and then also to be smart with the money. So that's what we're looking to solve for here.
Well, Greg, thank you so much for making the time. Where can people connect with you, find out more about Lone Star?
Yeah, absolutely. It was a pleasure to be on the show. I really appreciate connecting with you here. If you want to learn more about Lone Star Capital, you can find us online at www.lscre.com. Once again, lscre.com. And then if you want to reach out to myself regarding investing in any Texas workforce multifamily acquisitions, we're going to be very busy in 2024, 2025, and beyond. So, need help wherever we can get it to fund these deals. You can email me at Craig, CRAIG, at lscre.com. Once again, Craig, CRAIG, at lscre.com for any inquiries there.
Awesome. And we'll also make sure to add the website in the show notes. And thank you so much for making time.
Thank you so much for having me on. I look forward to hopefully speaking.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.